All right, today's topic, we're going to continue with S corporations, but as mentioned before, they are a flow-through entity, and we're going to discuss what that actually means. Hi, I'm Tony Cameron with TLDR Accounting, and as mentioned, we're going to discuss the taxation of flow-through entities, in particular an S corporation. So, as mentioned, S corporations, they do file their own annual tax return. So, step one, there's a tax return, has income, expenses, balance sheet, all of that lovely stuff. It gets reported on it, and then there's no taxes due. So, on the S corporation itself, they don't pay taxes. All right, so how do they then pay taxes if when you file the S corporation tax return, there's no taxes due? So what happens is part of the S corporation return is this a couple of pages called Schedule K1. What that is for each owner of the S corp, you then get a K1. The K1 reports income, expenses, and it breaks out your income into the various categories that then flow through to your personal tax return. It's one of the reasons why self-preparing an S corporation and a 1040 tax return, uh, when you have both of those, can be a little complicated and beyond most self-prepare tax softwares. So what happens is those income and expense items get passed through, hence why it's a flow-through entity, and then you get taxed on them on your personal return. Now, with an S corporation, we have talked about how you have to have reasonable compensation. And so you're already getting a W-2 from the S corporation, which reports your wages, which is then a deduction on the S corporation tax return. And then you have your flow through income, which is whatever's left. So say your income was $100, your wages was $75. You had then net $25 left of income. The $75 would be reported on your W-2. The $25 would be reported on the K-1, and both will get reported on your tax return. Now you're thinking, well, if the whole $100 is being taxed anyway, why would I be an S corporation? In this case, the $75 is like any other payroll job, so any other W-2 job. So there's payroll taxes on it. So that gets taken out and that gets hit on the $75. Now, the $25 is not getting hit with payroll taxes. It's just getting hit with your ordinary tax rate. So the difference between the two, normally about 15 and change percentage, that's what your tax savings would be. It would be the 15% of the $25. So yes, it can be complicated when you're looking at flow-through entities, but the big thing to remember is the S corporation itself isn't going to pay taxes. It's going to flow through onto your personal tax return. Hence why if you're self-preparing your personal tax return, when you have a flow-through entity, it can get a little tricky, and we tend not to recommend it unless you're a pretty savvy tax preparer. So, S corporation still needs to file its own tax return. It doesn't pay taxes, but the owners of the corporation will then pay taxes. And last but not least, most of the time when you have an S corporation and there's going to be pass-through income, so that $25, you take a distribution to cover the taxes on that $25. All right, I hope this helps. If it does, feel free to subscribe to our newsletter or follow us on YouTube to get the rest of our updates.